Okay, good afternoon, everybody. Hope you're doing well. I wanted to continue with the spreadsheet from Chapter 2 summary, and in Chapter 3 we move into adjusting entries. Now, there's basically two types of adjusting entries that have to occur, and those are things like what we call deferral entries, which are things like supplies, as you can see over here on the left, supplies that we've already purchased, but there's no process on a daily basis that is built into the accounting system to where we actually record supplies usage throughout the month. So at the end of the month, we basically walk into, think of supplies as being in a supply closet. We put $6,500 worth of supplies in the closet. We go into the closet at the end of the month and we determine how much is left in the supply closet, and the difference between the $6,500 that we put in there and the ending inventory that is sitting in there now is the amount that we use. So we've got to record the usage of the supplies. Okay, that's a deferral entry. Another type of deferral entry would be something like this service revenue, unearned service revenue, that a customer paid us for before we actually earned it. So they made a deposit up front, and now, again, there's no process to record the usage or the earning of this revenue within the daily accounting cycle. So at the end of the month, we go back through and we look at this unearned service revenue, and we determine, has any of it been earned? And any of it that has been earned, we reduce the unearned amount and we record a revenue. Okay, so notice what happens is, over here on the supplies and over here on the prepaid insurance, those are both prepaid assets. They become expenses. Okay, and then here on the unearned service revenue, it's a liability, and then it becomes actual revenue. So the prepaid assets or the prepaid expenses become expenses, and the unearned revenue becomes revenue. Then we have accrual entries that have to occur. So for instance, we've got this notes payable outstanding right here, and the interest, maybe the payments are due the 5th of every month. So maybe in the current month, we've actually incurred 25 days worth of interest expense, but the payment isn't due until the 5th of next month. So we incur 5 days worth of expense in the next month before the actual payment is due. So accrual-based accounting requires that we record all the expenses in the period in which they are incurred so that we can match them up with the revenues. So that notes payable, the interest has to be accrued, so we increase the liability for the interest payable, and we increase interest expense. Same thing with salaries payable. You've experienced this from an employee standpoint, but generally the idea is that maybe our payroll period runs from Sunday to Saturday, and then we don't get paid until the following Friday. So what happens if the entire work week, everybody showed up for work, and that was during the current month, but we don't get paid until the next month? Well, what happens is, again, we have to accrue those salaries, because for the business, the expense is actually incurred in the period in which everybody shows up for work. Okay? So we would have to increase the salaries payable liability, and we would increase the salaries expense. Okay? So let's take a look at the actual journal entries in the next recording.